so far, if you look at onshore and offshore markets, we are not showing a higher pace of default. I think we still believe by end of the year we'll look back, and I don't think that default rates will be higher than last year's. There is, you can call it a reckoning of sorts in the sense that the easy money is gone, and so with the policies of deleveraging and also the targeting of rhetoric towards, the clamping down of property sector, the talk of property bubble, all of this, also is coming off the back of last year's phenomenal property sales despite, COVID. And so I think that it makes sense for the government to want to, I think, contain the animal spirits, and also the deleveraging policies have been ongoing for a while to actually target constraining shadow banking side of lending, and the banks, are asked to constrain lending to the property sector. However, that said, there are also limits as to how much I think the government wants to push that, because you want people to behave, but on the other hand, I do think that the government's goal is still towards stability, and so all of these targeted policies are towards maintaining stability of the whole financial system.
Okay, but Monica, are they maintaining stability at the expense of creating moral hazard problems? Or do you think actually, given the level of defaults we have seen, you might look at this and say, okay, this is actually somewhat of a healthy correction or a healthy step, because it does indicate that, defaults will be allowed to take place?
No, absolutely. I think that it is healthy. I think all of this is for the longer term, better management of the whole financial system. I do believe this is a positive trend. On the other hand, I think there's some adjustment when we talk about reckoning. I think it's about adjustment to the way that people price premiums, and also how people approach investing towards markets. And so I think that is the adjustment that the market is going through, both onshore and offshore in our bond markets. Like I said, sort of the easy money is gone. But on the other hand, I think there's also currently a wave of overreaction to everything, meaning that people are very jittery, and so we can expect a much higher volatility in our bond markets this year than post-March last year.